Hello and welcome to this week's Midweek Markets, the podcast where I talk about what's been going on in markets and what will happen in the coming week. Now, before I actually start the show, I just want to talk about an event that I'm doing next week, a live event in central London with Habito, Nested and Moneybox, where we're going to be doing a panel discussion on all things to do with fintech, buying a house, investing. So come along, it's a free event. You can find out more about the event on the 3rd of April and it starts at 6:30. So if you go on our social media channels, you can find out everything you need to know about it and can register. And as I said, it is free. So let's get on with the podcast. Now, what's been happening in investment markets this week? It's been a pretty exciting week this week because we've had a real change. Now, last week we had the US Federal Reserve, which is the equivalent of our Bank of England, relay their latest interest rate decision. But what was also had the potential to move markets was how dovish they would be, or whether they would be a little bit more hawkish, and more importantly, what they would do about their QE tightening. So basically their unwinding of QE. And given that they were so dovish, markets were concerned that, well, there's a possibility that they might be slightly more hawkish than we thought and the market could fall away. What actually happened is they were even more dovish than we could have imagined, and as a result, they actually announced they're going to stop tightening or unwinding QE in September. The market obviously liked this idea and initially started to rally because don't forget, we've got like a massive liquidity, easy money has been good for asset prices over the last decade. So everyone was thinking buy the dip. But what happened after that was a similar fallout, which we had when the ECB about 2 weeks prior had announced some monetary loosening. And the market actually sold off and finished the day in the red. So you'd think if the central bank, the main central bank in the world is going to be possibly starting to loosen monetary policy further, certainly not tightening it anymore, that the markets would rocket. Well, they didn't. And it was a case of the market was worrying what they knew and maybe what they weren't telling us. A day later, the market then decided that actually everything was okay, so the market then rallied. So we got to the point that we were pushing up against that 2850 level on the S&P 500. The bulls were in full voice again and everything looked rosy. One day later, what we had was some dire economic numbers that came out of Germany, France, and actually some pretty poor numbers that came out of America. Immediately, there was talks of recession looming, and we've already talked a bit about there's a possibility of a recession already being prevalent or present in certain countries in Europe, particularly Italy. Investors became nervous, and what we got was a mass sellout of equities and people bought bonds. And the reason they do that is because if there's going to be a recession, then it's likely that interest rates will be cut. Now that's good for bonds because bonds pay a fixed income, and so that means that their actual income they produce becomes more attractive if interest rates aren't going up. Now obviously for equities, it means that if there's a recession, then companies are going to be probably making less profits, which will therefore hit their share prices. But we had something else happen, which was called the yield curve inversion, which is a phrase you're going to hear about probably for weeks and weeks and months on end. Now, to give you a quick insight into what yield curve inversion is, if you lend money via a bond or a treasury, which is the American equivalent of gilts, if you lend money to a government for a short period of time, you're going to get paid an interest rate. If you lend it to them for a long period of time, say 10 years, you're going to expect to get paid more. And the reason you're going to expect to be paid more, because there's a greater chance you might not be paid back, but also that inflation may rise. And so there's that opportunity cost you've got to be paid for. Now, if there is the possibility of a recession in the future, then what will happen is that bonds become more attractive, and it actually means that the central banks are likely to cut interest rates. Now, that will mean that you'll get less money or less interest on your gilt or treasury. Now, yield curve inversion actually refers to the interest rates you get paid for lending money to any particular government. Now, over the short term, typically you won't get paid much because it's a short-term risk. Over the longer term, you'll get paid more for the opportunity cost and because of the likelihood of inflation and interest rates going up, which is what happens in an economy that's actually humming along nicely. Where there's likely to be a recession, the central banks will likely have to cut interest rates. So therefore, that means that in the longer term, there could be the chance that you'll get a lower interest rate in the general economy, which therefore makes bonds more attractive. So people buy them, and that therefore pushes up their price. what it means is if you get the yield that you would get and plotted it, say like on a 1 month, 3 month term, a 1 year, all the way through to 10 years, you get this nice slope. So the interest rates go up as you go out longer term. Yield curve inversion means that we actually get higher interest rates at the lower end than we do at the higher end. Now, you don't have to get too bogged down by all of this, but what it really means is that it happened when the yield curve inverts. It's a very rare occurrence, and it actually happened on Friday, so last Friday. And as an indicator, it's a pretty reliable indicator going back to 1950 that there's going to be a recession in the US. And now if there's a recession in the US, it tends to be a recession globally. Now, if the yield curve inverts like it did on Friday, that tends to mean that you've got about a year to 18 months until a recession occurs in the US, and that is based on history. So in that scenario, the market panicked, bond prices rallied, people bought them because obviously if there's a recession, bonds tend to be a better investment to hold, and equity prices tanked as a result. And we saw the S&P 500 and nearly every other equity market fall by at least 1%, some of them as much as 2% in the case of the FTSE 100. We got to a scenario where the bears were cheering because we suddenly unwound a lot of the good stuff we'd done on the technical side of pushing the markets higher, and investors suddenly became nervous. We went back below the 2,800 level on the S&P 500, opening the door to perhaps going lower, but the market so far has found a lot of support around sort of 2,790, 2,780. If we break down below probably about 2,770, then we might want to watch out below, but it's still that 2,700 level, which is where we want to, it's probably the floor of the market at the moment. If we go through that, then we are probably going to have a few more problems on the downside. So where we are at the moment, the market still has this uptrend, but it's back to trying to break out of that 2,800 to 2,825 zone. So we're in that case where, yet again, we're bouncing along this zone. We've been trying to get out of it for about a month, and we're back in it again. So what this means overall for your portfolio, you will have seen bonds doing really well. You will have seen your equities bounce up and down. The yields around the globe are tumbling. So anything, if it's gilt, if it was the German Bund, they're actually negative at the moment on the sort of 10-year term. So bonds have been a very good investment since the start of the year. Now, there's an interesting dynamic. That's why you need to diversify your portfolio, because if you do, then it means if equity markets tail off, then your bond portion of your portfolio may pick up, or whatever asset you actually hold. Now, for 80/20 investor members, I'm doing a whole piece about the perfect ISA portfolio, which is meant to make money in any given environment and actually outperform the FTSE 100 as an index. And that's been tested going back as far as the year 2000 when ISAs were launched. So I'll be updating that this week to show you what the asset mix or the perfect asset mix is if you want to make money in any given environment. So look out for that. As usual, do send in any questions that you have to Damien at moneytothemasses.com, to my Twitter handle at moneytothemasses with the number 2. So until next week.